Welcome to Coffee and Crypto with Lee and Jimmie. I am Lee Reiners, joined as always by Jimmie Lenz. Jimmie, how are you doing, man?
Man, I'm doing pretty good this morning. I'm rocking my Norm Abrams shirt again. It's feeling kind of chilly outside, so I figured I'd put the flannel shirt on.
Absolutely, looking sharp.
Yeah, I'm much more Norm Abrams than Portland.
Norm Abrams.
Yeah, Norm Abrams. Norm Abrams from This Old House. Oh, come on!
No,
you had
dude,
to have seen that.
watch.
No, you don't.
That's PBS, right?
Man. Huh? PBS.
Is that PBS?
Yeah. PBS.
Yeah.
They build. He's a carpenter and cabinet maker.
Gotcha.
Oh, I'm a huge fan of. I think.
Wow.
To me,
I've heard of the show. I've heard of the show. I know.
You've heard of the show.
I just don't watch it. I don't watch it.
Oh, I've watched it for 40 years, probably 30 years.
Wow, it's been around that long.
I'm a huge fan of craftsmen. You know that. I mean, I'm a really, really big fan of craftsmen and all kinds of craftsmen. I think writers are craftsmen, and so
of course.
I read a lot of books simply because of the way the author writes. Not so much the content sometimes. There are certain writers that are just so phenomenal at their word choices and phrasing choices. And much like cabinet makers. Cabinet makers are, they work on something until it's perfect. Not that crap that comes out of factories from choose your country. But these are actual craftsmen that do this.
I hear you, man.
Yeah.
You got to appreciate dedication to and mastery of like a very sort of narrow task.
Oh,
right?
Absolutely. Mastery of a craft is, I mean, people spend a lifetime doing that. All kinds of, and there are all kinds of craftsmen out there, but yeah, I'm a huge fan of people that do that kind of work. So yeah.
Would you say that we are digital asset conference craftsmen?
We kind of are, yeah.
We're crafting a world-class.
We're crafting quite a conference. 4 years now. 5 conferences, 4 years, and I think we have crafted something that's very unique, for sure, in the digital asset space.
Yeah, I mean, again, folks, got to get on it. digitalassets@duke.org. We still have seats available. It's really a who's who of builders, policymakers. I mean, we got our good friend Rodney Hood, who at the beginning of the Trump administration, second Trump administration, was the acting comptroller of the currency. A lot of news obviously coming out of the OCC recently in regards to digital assets.
In the Genius Act.
Well, he played a role. He played a role. We also have Brian Quintenz, who is head of crypto policy at A16Z. Was President Trump's first nominee to chair the Commodity Futures Trading Commission. That didn't work out so well, right? I think folks who follow digital assets are aware of that saga. Nothing to do with Brian and his qualifications, but really pumped to have him.
Bo Hines is going to be at the conference,
right? Bo Hines,
which is great. North Carolinian.
Native North Carolinian. Was worked for David Sachs in the White House. Really spearheaded crypto policy efforts. So. That's just on the policy side of things, folks. Okay,
we have some really outstanding builders. I mean, it has turned into, as you said, a who's who of in the digital asset space, and I'm really looking forward to this year's conference. I think last year we talked about a lot of brand new products that were coming up, in particular retail oriented products. And there has been a lot on that forefront. We're seeing more products coming out. But we're also seeing a much broader range of products coming out. And so they, speaking of, and the other thing I think that you get at the conference is people are very open. This is not everything scripted. Everything is, written, read from a script. We get a lot of, I'll call it, unvarnished opinions that come out at the conference. And a lot of very open discussion. We don't script that. We don't have, people that we plant in the audience or anything along those lines. These are for real questions that are coming from real people. And with that, it's a nice lead into one of the big stories this week, actually, out of Bank of America. It used to be Merrill Lynch Bank of America. I think it's now just Bank of America. I think they dropped Merrill Lynch. How could that be? Merrill Lynch,
BAML, right? Don't they still go by BAML, like Bank of America Merrill Lynch? Or,
But anyway, they came out with something that, last year we had just seen ETFs roll out and those kinds of things. And all the big brokerage firms were saying, nope, not our clients. We're not going to allow this. And I said in front of everybody, hey, before the end of the year, we will see allocations that are, spearheading, retail portfolios, and they'll be, everybody will be jumping on that bandwagon. And what happened this week? Merrill Lynch came out and said, hey, we have an allocation asset for digital assets for our retail clients.
Yeah, they did. They said 1 to 4%. Okay. They're endorsing 1 to 4% allocation of digital assets for clients of their Merrill, Bank of America Private Bank, and Merrill Edge platforms. In addition, its investment strategists will begin covering 4 Bitcoin ETFs in January. So again, folks,
what a sea change, huh?
Yeah,
what a sea change in opinions.
Bank of America.
If you'd have been at Digital Assets at Duke last year, you'd have heard it.
For sure. I mean, look, there's been a clear trend. Okay. And I think even more telling, Jimmie, than this Bank of America recommendation of 1 to 4% is Vanguard.
Okay? Oh,
Vanguard.
For those of you who don't keep up with it, Vanguard just got a new leader, and everybody.
From BlackRock.
The rumor is, one of the reasons they have a new leader, although the old one retired, he was also very against doing anything in the digital asset crypto space. And man, did they lose out. They lost out in such a huge way. And now they have a new leader and a new position in digital assets and cryptocurrencies. And they are going to start, and actually not start, they're going to jump in with both feet into the space because they've missed out. I mean, just unbelievable.
I don't think it's cost them too much at this point.
Really?
I think
look at BlackRock's balances.
Well, I mean, that's on the issuance side. That's on the
But remember, Vanguard issues a lot of their own stuff. They have the Vanguard
ETF franchise,
and Vanguard funds.
For sure. So the story here, folks, is that Vanguard is now going to allow ETFs and mutual funds that primarily hold cryptocurrency to be traded on its platform. Okay. So self-directed brokerage account clients will now be able to go to Vanguard and buy ETFs that follow Bitcoin, Ether, XRP, and Solana. This is obviously a change from their prior stance. The leadership of Vanguard had been very skeptical of digital assets in client portfolios. They thought it was too volatile and speculative. I think if you know the history of Vanguard, and we've talked about it on the show before, Jimmie,
we've talked about
a surprise.
It.
Look, John Bogle is.
He pioneered this. He pioneered low cost investments.
Index, and so it wasn't a surprise to me that of all the firms out there, that this was the one that was sort of most cautious.
I don't know. I'm a little mixed on that because he was certainly a pioneer. Jack was a pioneer when he started doing low cost investments. He pioneered a new way to invest, and hey. It served them really well.
The shareholders own, where the fund investors own the company, right?
Yep. And so I think if you think about that, and you think about what he did as far as pioneering and new things and bringing new things to market, I mean, they should have jumped on this bandwagon, and instead, I think they've actually veered 180 degrees from his original vision and said, no, we're going to be very staid. We're going to be very staid about everything instead of being pioneers.
I think their original vision was to be staid. I think their original vision was boring is better, right? Passive, not active. That active investing is a loser's game. That you can't beat, right? A random walk, right? A random walk down Wall Street. It's a loser's game. the best strategy is to buy and hold the entire index via low cost ETFs.
But that was
And
at a
crypto is
time.
just not compatible with that. I mean,
Well,
it's
I
way too
understand, but that was
volatile.
at a,
There's no there. I mean, look, what's the valuation? We've talked about this a million times. So
yeah.
you look at Bitcoin, it's $92,000. What model am I using to determine if it's overvalued or undervalued? I mean, I think these are all things that were anathema to what Vanguard stood for. And look, like everyone else, Jimmie, they're just following the demand. The demand is there.
The demand is definitely there.
And this is what they're doing. They're saying, look, our clients are asking for these things.
But when they started this, when they started allowing people to, really inexpensively invest in whole indexes, that was the heyday of active management. If you were to look at the top 10 money managers, they were all active. So they were very, very, much following a unique path, a low cost path. And it was the right one, but it was a low cost path to, broad market indexing. And all of a sudden, they decide we're going to stay with this forever. We're not going to ever make any changes. And instead of staying the course, what they do, they change management, which I applaud them for. You have to be dynamic.
Yeah, well, Vanguard is you're just saying they should be contrarian for contrarian's sake. All right. Well, let's stick with let's kind of stick with this because we've talked about MicroStrategy, now Strategy, and the whole digital asset treasury company thing, and we don't need to beat that horse.
Nah.
But there is a kind of an issue here that's come up that's sort of overshadowing certainly Strategy and digital asset treasury companies in general, which is MSCI.
Mm-hmm.
Right, which Morgan Stanley. I forget. But is it still part of Morgan Stanley? I think it's spun out.
MSCI is still part of Morgan Stanley.
Okay.
Yeah.
Anyway, they're an index provider, right? So they just
they build indexes of all kinds.
They build indexes, and then as we just talked about with Vanguard, right? Then asset managers develop products designed to track that index.
Yep.
And so it's been reported that MSCI is considering removing companies that have more than 50% of their balance sheet made up of digital assets from their indexes, right? From their broad indices. And of course, that would be a significant move because then you wouldn't have all this passive money going into these companies, right? So there'd probably be a sell-off associated with these companies. And the logic for this is that the whole point of an index is to track, right, operating companies, right? It's not
it's a broad. It's usually a broad spectrum.
But you don't. It's a broad spectrum. But you don't have investment funds in an index, right? Investment funds track an index, right? So like it's not as if you have like an ETF or or a mutual fund in an index. So the logic here is that look, these digital asset treasury companies are essentially investment companies, right? They raise funds, they issue debt and equity, and then they plow the proceeds into digital assets. And so it doesn't make sense for these companies to be included in a index where all the other companies in the index are actual operating companies, right? Building products, services, whatever it may be. And of course, the biggest sort of I don't want to say target because it's not as if they're doing this intentionally to single anyone out. But Strategy, of course, this is pretty big because they're a large company, they're the largest digital asset treasury company, and I think some folks are starting to panic a little bit, and so the Digital Chamber of Commerce, recently sent a letter to some members of Congress. I know Strategy itself sent a letter to MSCI. And, they're basically asking MSCI not to do this and explaining why they shouldn't. I think, frankly, MSCI is well within their bounds to do this. It makes perfect sense to me. And some of these arguments that they're making, it's like one of the arguments is well, ExxonMobil, more than 50% of their assets is in, oil, right? So they're an oil treasury company.
That's probably not a good argument because it probably isn't.
I don't know if it's exactly what they're saying, but they're basically trying to say look, we're not all that different than other sort of commodity-based companies, but they are different, right?
Absolutely.
These arguments don't carry much weight.
There's no comparison. And it reminds me of a lot of companies that are, well, I'm not going to go into types of companies because that's another whole other can of worms. But yeah, I mean these types of companies that basically have one asset and they don't build anything. I mean, it's kind of ridiculous that you would put those into an index. It doesn't really make sense. In particular, if you have some other exposure to the actual underlying asset, right? I mean, why would you do that? All you're doing is basically compounding the same thing over and over again.
Yeah, I agree. So we can move on.
Yeah.
Let's go to the BIS, and you and
Bank of International Settlement.
I think we talk about BIS research more than anyone we know. I know
we probably do. I mean, I think you're right. We probably do talk about the BIS because they, in the past, I mean, they've always been very prolific. They do a lot of studies, as well they should. But they seem to really be pumping out the research these days, don't they?
Well, we're talking about it, so they must be. Certainly research that we're interested in. And I was thinking about this the other day, Jimmie, too, which is obviously the Trump administration is, gung-ho on crypto. All the regulatory agencies are, rolling out the red carpet for crypto. But there's really a dearth of research on crypto markets coming from within the government. And it's just kind of odd to me that like you would be, so supportive and yet really not put out information or quality research about what's going on in these markets. And you see this.
I will say, being a researcher, research takes a long time to catch up.
They've had
part of it is because there is no, until you have data, it's really hard to do research because most research, let's face it, is done by academics.
Government. Even if the BIS is not BIS.
Well,
BIS. Doing research,
I mean, but if you look and see the BIS, the Fed, they have think tanks that look a lot like academic labs.
They are doing academic quality research for sure. I mean, look, the Federal Reserve is the largest employer of PhD economists in the world.
Yeah,
right. I mean, every Federal Reserve district bank has a research department.
You can go
to their websites. And they publish things. They publish things, on Fed sites. They publish things in academic journals. And these, the things that they're publishing are, obviously directly related to
what they do
for a living.
Mission.
Well, to the Fed's mission.
Right.
But sometimes it's outside of that too. I mean, it's not as if there's not, these research departments at the Fed are look, they're not being like censored. I mean, they're largely independent.
They're good.
They have freedom to essentially do the work that they want to do and what they want to do. I'm not saying the Fed should be the one doing this work, but look, Dodd-Frank created something called the Office of Financial Research that sits within the Treasury Department, right? The point that I'm making is that after all these years, Jimmie, it still is just kind of beyond me that within the U.S. government, whether it be the Fed, right, the Office of Financial Research, the SEC. I mean, there's the Office of Chief Economist at the SEC that we're relying on BIS research. And great job, BIS. You're doing fantastic. We'll talk about this paper. But I just don't know why no one within the U.S. from a government agency perspective is putting out, frankly, any research. The Fed is doing some, the New York Fed in particular.
I was going to say the Fed's doing some.
But this is a big market. It's a growing market. The Trump administration is giving it a bear hug. There needs to be a commensurate research effort to inform what's going on.
So I would say at Duke, and in particular at the engineering school where I am, I mean, we've published 2 to 3 works a year in academic journals on digital assets. Amongst not just me, I mean, we have a number of authors that have published works, and so I think there is a fair amount being done in academia. I think there's a lot of crap
not a lot
in academia.
Not a lot.
This isn't government. This isn't government work.
Yeah, but even within academia, there's not a lot. I don't think, frankly.
Yeah,
I mean, you guys stand alone.
I mean, we may be. It'd be interesting to look and see where things are coming out of. I know there are a couple of guys at MIT that publish a lot, so there is some, but within the government, there doesn't seem to be a whole heck of a lot coming out besides the Fed. BIS is doing their fair share for sure. I don't know why there's not more.
Well, that was just my little rant.
Perhaps one of us needs to be running a research agency in the government.
Well, this is what if I'm ever get to run one of these agencies, like, the SEC, for instance, right? Like, there's no reason the SEC shouldn't have like a dedicated team of like crypto researchers, right?
Yeah,
Who
I would
do the
agree.
data analysis that are include developers and whatnot, and they can publish things, they can put things out there.
Sure.
So anyway, I think it would be helpful and informative to the broader
So
policy effort. So anyway, the BIS.
if any of the commissioners are listening, at the SEC, and you want some more info on that, give Lee or I a call. We can probably point you to some people.
Yeah, like a whole, dozens of students that you teach every year. Okay, Jimmie. Well, so anyway, this was all a segue into a new paper, a bulletin, they're calling it,
Bulletin,
from a handful of folks at the Bank for International Settlements, called "The Rise of Tokenized Money Market Funds."
Right.
And it's a short paper, and I thought it was just like a great explainer, frankly, which is why I wanted to talk about it. So, we've referenced tokenized money market funds. Folks are reading the headlines.
Yep.
There's different varieties and flavors of these things. And I thought that the paper really did a great job sort of explaining that, and also breaking down the operating model too, which I thought was quite informative. And I've been thinking, Jimmie, like, we're spending so much time talking about stable coins and the future of stable coins and, this whole so-called payment of interest loophole, right? And I'm wondering if we're maybe getting distracted by the wrong thing. If tokenized money market funds aren't the thing that we should be thinking about.
Now.
You have been, to your credit.
Yeah, I don't know if you remember about, gosh, it had to be probably one of our first or second conference, Digital Assets Institute conference. I raised the idea of a tokenized money market fund, and I'm not going to say who they were, but I remember the two panelists who I was asking the question to, and both of them poo-pooed it and said, "Oh, that'll never happen. Nobody would ever want to buy something like that."
Whoa.
Yeah, off the podcast, I'll tell you who they were.
Okay, I'm not remembering.
You don't remember this? Oh yeah, and I
remember you talking about it.
Yeah,
I don't remember the people who poo-pooed you though.
Yeah, I remember both. It's two guys.
Of course.
But the idea of the tokenized money market fund, I mean, the BIS calls out, hey, they could have the same issues as traditional money market funds. Around liquidity and duration mismatches and things like that. And they talk a little bit about anti-money laundering, which I don't really think is as big a concern. But they threw that in the paper too. I mean, the paper that Reed Timsio and I did, I mean, we talked about this at length, the investments and the limited number of investments that are there for a money market fund type of structure. I mean, there are some limitations, for sure.
For sure. So a couple of things. We talk about stable coins and we say, okay, what are the benefits? Well, it's, borderless and near real-time settlement, programmable 24/7 and whatnot. But then, the critique is like, well, you just don't get yield if you hold stable coin. And that's a lot of the policy argument right now in terms of, implementing the Genius Act. But, tokenized money market funds, kind of have all those same properties associated with stable coins, yet also provide yield, which is kind of why I'm thinking like, well, this is the thing we should maybe be talking about and focusing on more, especially as DeFi grows, right? And so this might be self-evident to some folks, but I think it's worth repeating. As the BIS paper does, and they say, look, the whole premise of DeFi is that these are applications that run on public permissionless blockchains where market identities are unknown, right? It's just, an address, right? A public address. And so when you don't know your counterparty, but you want to do derivatives or other types of financial transactions, that means you're going to need collateral. Specifically, it's going to be significantly over collateralized, right? So all these DeFi protocols, right, rely on significant amounts of collateral. And thus the rise of tokenized money market funds, right? That they can be used as as collateral that also provides yield to the holders. So there's significant amounts of over collateralization driving up the aggregate demand for these things. In terms of how they're structured, right? Tokenized money market funds are, of course, digital representations of regulated funds. Okay.
Right.
So they've been launched by fund management companies such as Franklin Templeton and BlackRock and BITL. We've talked about a number of times. Okay? But there's also crypto native companies, Circle, Ondo Finance have entered the market. But the legal structure can differ, right? So some just represent shares in a conventional U.S. government money market fund, right? But others are not money market funds at all, but they're just private funds for accredited investors. And that structure has certain benefits. It's flexibility, some greater flexibility, tax benefits. But their shares in that case can only be offered by so-called qualified purchasers. Can only offer two so-called, right?
They can only be offered two of those. And to institutional investors, and a lot of times there's a minimum. So I think this is BIDL, and there's minimum, balances, right? Now, one of the reasons for back to the operating model, and just so people don't think that that's exclusive to cryptocurrencies, if you look at any money market fund, they all have institutional class shares that you have to be an institution, you have to be an accredited investor, and usually has a minimum of $1 million or $5 million, something like that. So this is
not uncommon,
right along the lines of very traditional finance.
Yeah. So the paper goes on to say that because of compliance reasons, tokenized money fund shares do not flow freely between wallets of unknown beneficiaries, right? Instead, investors need to be onboarded by the fund administrator, and they create what are called allow list wallets. So these are wallets that have all been pre-vetted to ensure that they comply with anti-money laundering, countering the financing of terrorism rules. Okay. So these cannot move from one unhosted wallet to another unhosted wallet as of now. There's a growing standards, right? So we talked about ERC20 a lot, right, for tokens on Ethereum. Well, because the programmability and the allow list features, and then of course, there's yield. So there's a development of standards. ERC 3643 seems to be the leading standard for tokenized money market funds, right? And then there's a lot of intermediaries involved in these things, right? So I think that's an important point that I wanted to make, because I think folks think, oh, well, if it's tokenized, it's decentralized or whatever. Not the case, folks. Okay. So first, to subscribe, right? Allow listed investors transfer money or stable coins to a digital transfer agent. This transfer agent can either be affiliated with the fund management company or an external service provider. So for example, Securitize is a transfer agent for BlackRock's BIDL fund. The agent then links between the off and on-chain interfaces and manages the shareholder register. Once the transaction is settled, tokens representing funds are minted and credited to the investor's wallet, while the proceeds are invested in money market instruments. Now, those money market instruments, like treasuries, for instance, they are not, by and large, at this point, tokenized. So there is a mismatch, and this is one of the risks that the BIS calls out. Jimmie, my thoughts are, the next step, right? The next evolution here.
Yeah.
I would have to imagine Secretary Besson is thinking about it, tokenizing treasuries, just issuing treasury securities directly on chain.
Yeah, that's come up a few times, the idea of tokenized treasuries. And you and I have talked about it a little bit. The kind of the Trump administration, has obviously expanded the application of crypto and digital assets to a lot of things. Could this be an entree to tokenizing different kinds of debt? And people who are listening probably realize this, because they're listening to us talk about it. But there are a lot of advantages to doing that. I mean, all of a sudden, rather than just having exposure to a certain cryptocurrency, you could have exposure to U.S. debt, and that's a very valuable thing for people, right? In particular, short-term debt. If you're in a country where you have rampant inflation, things like that, you want to lock in the value of your currency. A treasury is a really good way to do that. Buying stable coins is a really good way to do that. And so could this provide an avenue to float more debt at a reasonable rate? One would think it could. I'm just saying.
And Secretary Besson is very focused on the treasury market,
absolutely,
right? And the resiliency of the treasury. I mean, he just had a financial stability oversight council meeting yesterday.
Big presentation on that.
And one of the work streams coming out, for the FSOC going forward, will be treasury market resiliency. So I would have to imagine he's thinking about this, and that there are teams looking into this. Now, look, it is the biggest credit market in the world. It's the most important credit market in the world. You do have to proceed cautiously. You don't want to break something like this or disrupt something like
No,
this.
you can't. We can't disrupt it because it is, as you said, it's the largest treasury market in the world. It's the benchmark for untold thousands of other types of assets. We can't have any sort of hiccups in that market because we've seen what happens when there are. I mean, you get big things that seize up and all kinds of problems that occur. So it has to be done, I think, with a lot of thought. And but this idea of tokenization of U.S. debt, I mean, I can definitely see it. It's the debt is being used in.
Do you have a timeline? When's your call for when it'll happen?
Within 12 months, we're going to see it. Within 12 months. Yeah.
Wow, that's huge.
I think we will. It will probably be so. My guess would be there. You will see an issuance. And by the way, folks, new debt is issued like every day. You just don't realize it. But remember, we have bills, we have notes, we have bonds, we have lots of denominations out there that turn over on a regular basis. And so, and there are a lot of different assets. There are a lot of different things that depend on that. Swaps that are out there and repos and all kinds of stuff like that. Anyway. What I would expect is we would see kind of a partial. So maybe a new issuance that comes out that's 50% traditional, 50% is tokenized. That kind of thing I could easily see occur.
Oh yeah. It's not going to. Yeah, of course. Yeah. There'll be a transition period. But look, I think this is important to the future growth of tokenized money market funds, because as long as the funds themselves are investing in off-chain assets, which they are now, then you're adding new, risk and levels of intermediation, right? So, for instance, the calculation of the fund's NAV relies on pricing information, right? Usually get received once a day by off-chain services, right? Oracles, okay? Yeah. Custody and proof of ownership of the investments are still performed off-chain, right? So, this is a growing market, as the BIS notes. So at the end of 2023, tokenized money market funds had 770 million in, total value locked. It's essentially equivalent to assets under management. That is now at $9 billion at the end of October. So that's pretty significant growth
it's significant growth
in 2 years' time.
A very, very, very small drop in the bucket of money market funds. So, folks, money market funds, U.S. money market funds, just in the United States, it's over $7 trillion invested, and another $2 trillion outside the U.S. So this isn't even a drop in the bucket yet. This is a drop off the side.
And 2 more points, Jimmie, on this paper that I thought were really interesting, that I had been previously familiar with, is the change in the blockchains that tokenized money market funds are issued and trade on. So 2 years ago, it was almost exclusively Stellar was the chain that tokenized money market funds were issued on, and because it allowed cheap transfers and much smaller amounts than other blockchains. Now it's over 50% are on Ethereum, okay? Because of the stability and security provided by a large number of validators, as well as smart contract capabilities. So they have a great chart in there that highlights this. To me, that's just crazy that it used to be all Stellar just 2 years ago, and now it's essentially moving towards Ethereum dominating.
We've talked about it before. I mean, the EVM standard, it's just become a standard protocol. Yeah, we talk about all of the things that are very independent, all the things that are, that they kind of make up the whole blockchain and cryptocurrency ecosystem that revolve around, independence. And, but at the end of the day, people don't want to have to code for 5 million different protocols. And so the EVM protocol, I mean, it's almost become a standard. You hate to think of it that way, but it's why we have basically in PCs two, right? It's come down to 2. It's either a PC or an iOS device, and that's just the way it is. At the end of the day, things are going to coalesce around a single platform, and I'm not going to say it's always the best platform, but things are going to coalesce just because, hey, frankly, it's easier.
Fair enough. Final point, Jimmie. Concentration of wallet holders is crazy. So
people forget this.
So DeFi protocols are the main investors in these tokenized money market funds, notably the BlackRock BUIDL.
Yeah.
Okay. For obvious reasons when you think about it, because tokenized money funds, they are collateral on DeFi platforms. They allow users to borrow stablecoins by pledging their tokenized money market fund, right?
Yep.
So when we look at BUIDL and the Wisdom Tree government money market digital fund, around 90% of total holdings are in the hands of only four wallet holders,
Four wallets.
folks.
Yeah.
Right.
People don't realize how concentrated. I mean, and you can look at any of the cryptocurrencies. If you look at the number of holders, you look at the wallets, I mean, it is very, very, very concentrated. Hey, you know what, Lee? This is a reflection of, or this mirrors
life,
traditional world.
Yeah,
traditional world. I mean,
the rich get richer.
Yeah, yep. I'm just saying there's a lot of concentration of assets. I mean, of all kinds of assets, and these kind of mirror the rest of the world.
Shocker. Yeah, I think it's not. There's more. I think it's more nuanced than that too, though, because it's because they're in wallets that are controlled by the DeFi protocols, right? Because they're serving as collateral. So I think it's just back to the point that I made up top on this segment, which is DeFi requires significant amounts of over collateralization. It's pretty clear that tokenized money market funds are fulfilling that need. Final story for the day, Jimmie. Quickly here, the CFTC. I think this is in keeping with what we've been talking about in collateralization. They announced earlier this week a pilot program to allow certain digital assets, specifically Bitcoin, Ether, and USDC, to be used as collateral in derivatives markets. Your thoughts, Jimmie?
I think it's a good idea. I mean, for folks that don't know, in derivatives markets, you always have to post some kind of collateral, and the collateral is often called a daily, but sometimes even interday. And so, and you have to maintain those. You have to maintain that. Otherwise, you're sold out of your position. You'll get a margin call, those kinds of things. And so, the one that kind of surprised USDC didn't surprise me at all. I mean, it's a stable coin. It's easy. The one that kind of surprised me, honestly, was anything that's not stable, because it kind of adds a layer of complexity to whoever's holding the collateral, because you're also monitoring and hey, a lot of things are collateralized by other assets that move, and it's not always USD. But I was kind of surprised they went that far. Stable coins, I mean, that just made sense to me. But other assets, I was a little bit surprised at, because I think it's going to put a little bit more pressure on some folks that decide to do this. But I'm not surprised at all, as people hold more and more assets in digital asset form, having those become good collateral. I'm not surprised. Are you?
Well, I mean, I'm not surprised, just given the CFTC and how it's frankly been captured by the crypto industry. But I watched an interview with acting chair Pham on CNBC, and she was arguing that she made the claim that for Bitcoin and Ether, and I think also USDC, that it can be used as collateral only in derivatives contracts which are denominated in those digital assets. Which when I actually read the staff letter, I didn't see that. I might have missed it, but I don't think that's either. I didn't see that. So I don't know, what she's talking about, frankly, which is kind of how I feel about a lot of things she says. But yeah, I mean, generally speaking, right, there's permissible categories of collateral, and those categories tend to be.
I don't think people realize that,
stable.
Lee,
that
when you have any sort of collateral that you need to post on a financial transaction, or as a guarantee, like guaranteed delivery and things like that with the DTCC, there are definitely collateral that's permissible and collateral that's not. Typically, it's collateral that's that doesn't move a lot, that doesn't have a lot of volatility to it. Because if you have to exercise that right, you don't want to have to worry about, is the collateral worth what I thought it was worth?
Exactly.
So that's what surprised me. I mean, usually it's short-term bonds or cash are collateral. So I was, like I say, the USDC, that's basically like cash. But the other assets, I was a little bit surprised.
What's also surprising, but not surprising at the same time, is that the press release that the CFTC put out, it has quotes from crypto industry executives. Okay. Like this is, come on, folks, let's get serious here. I mean, it's got a freaking quote from, the chief legal officer of Coinbase, the president of Circle, the co-founder and CEO of crypto.com, the SVP of stablecoins at Ripple, all praising the CFTC in this pilot. And it's just like, this is not a good look.
What is a press release?
But it's a press release from the CFTC, from a government agency. You should not be soliciting quotes praising this move from the crypto industry. I mean, it's just
that is a little odd, but it is a press release.
It's like if imagine if the Federal Reserve put out a press release saying that they were, going to propose a new rule that would lower bank capital requirements, and in the press release they had a quote from Jamie Dimon. Yeah, like praising the, I think we would all recognize that, like, that's not appropriate.
A little bit pandering.
Yeah, a little bit, but because it's crypto, somehow there's, the decorum flies out the window.
I don't know if it's because it's crypto or if it's because it's the CFTC.
Well, it's a combination of both. All right, brother. All right. This was a lot of fun, man. Have a great weekend, and we'll do it next week. Maybe we'll do a little naughty and nice.
We could do that. It's almost that time. That's almost that time. We should do what we should do. The naughty and nice is always a good show.
Let's do it. Okay, next week is going to be our crypto naughty and nice segment.
There you go. Have a good weekend, Lee.
Take care.